Good afternoon. Welcome to Technology Developments, Blockchain, Leading Change in Financial Markets panel.
All right, welcome. We have an exciting panel today with some of the most interesting executives who are working on dynamic changes in our securitization market. They're changing the way we do business. And one of the things that I found in the last couple weeks during our panel prep is every time we've met, I've sort of learned not just about all of you, but about interesting ways of changing the markets, and it's really been fascinating to me. So I think we have a really dynamic discussion in store for you, and hopefully you'll feel the same way. But before we get started, I wanted to just introduce our panel briefly, and each one will, after I give a brief introduction, will explain a little bit about what they do, how they got involved in the blockchain, and we'll go from there. I'm Stephen Becker. I'm a partner in New York at Morgan Lewis. We also have John Wooten, the founder of Block Transfer, Ian Ferreira from Liquid Mortgage, Nelson Chu, the CEO of Percent, Cara Newman, Managing Director, Head of Structured Finance at Redwood Trust, and Frank Wygand, General Counsel and Head of Listings at Oasis Pro Markets. But first, a little bit about myself. I'm mainly an asset-backed finance partner specializing in residential mortgage assets and other asset classes, such as solar and unsecured consumer assets. I work mainly with repo structures, but have financed collateral using loan and security agreements, gestation facilities, securitizations, and everything in between. Prior to attending law school, I worked for 4 years at the Prudential Home Mortgage Company. But the way I became involved in the blockchain is the way most lawyers get involved with things. One time, about 4 or 5 years ago, a client called me up and said, we're going to do a financing with a company that's originating loans on the blockchain. What do you know about it? And I said, I know a lot. And I immediately just started Googling and reading. And then, and after one deal, they put me on this panel. So it's really quite something. But in any event, I did, one little fact, I did program computers at Accenture for a year before I went to law school also. So I tell my kids it's COBOL. They have no idea what I'm talking about. In any event, John, you want to tell us a little bit about yourself?
I'm John from Block Transfer. Nowadays, if you want to transfer book entry securities, you have to print, fill out a bunch of complicated paperwork, go to the bank, have them sign and stamp everything, snail mail all that in, and wait weeks for a response. We're the first transfer agent built with direct blockchain records. That means no more pesky medallion signature guarantee stamps. Everything uses modern cryptography. I got into the blockchain space 5 years ago through my trading, and fun fact, when I built my first mining computer, I spent more time setting it up than it did mining.
Excellent. Ian?
Ian Ferreira, CEO and founder of Liquid Mortgage. Prior to starting Liquid Mortgage, I was actually a mortgage trader, so traded mortgage-backed securities and asset-backed securities for a hedge fund in New York, and started Liquid Mortgage on the basis that we need to change some of the infrastructure that underlies a lot of securitization markets, but also loans as well. And so what our company does is we create one-to-one backed digital assets for each loan we onboard. And so that loan has a unique individual identifier on the blockchain, and then we have the ability to capture data, documentation, and payment history over the life of the loan on our platform. And so currently today we have $2.7 billion of assets on the platform, roughly 2,800 loans. We've also tracked over $230 million in payments as well. And all of that information comes directly from servicers through us, and we can post within 30 minutes of receiving that data to give investors access to that data.
Thanks. Cara?
I'm Cara Newman. I'm head of structured finance at Redwood. For those of you unfamiliar with Redwood Trust, at a corporate level, we're organized as a REIT focused on mortgage credit. I work for the residential business, which is focused on the acquisition and disposition of residential mortgage loans. Up until pretty recently, my job was squarely in the traditional finance or TradFi space, to use the technology lingo. I work on execution of new issue Sequoia securitizations and managing risk on the acquisition and distribution of whole residential loans. Increasingly in late 2020 and 2021, Redwood began to focus on ways to integrate technology into our business, Around that time, Redwood launched a venture investment arm called RWT Horizons, which makes early-stage investments in companies that have a nexus with Redwood's core businesses. Two of those companies are represented on the panel today. That's Liquid Mortgage, with whom I had the pleasure of working on the first Sequoia transaction to integrate blockchain technology. That was in 2021. And Oasis Pro Markets, which is well, I'll let Frank explain what your company does, but we're collaborating with Oasis Pro Markets to integrate tokenization into Redwood's business. The first example of this collaboration was a thesis of the case for tokenization in structured finance, which we published in collaboration with Oasis earlier last week.
Great, thanks. Hi, everyone. My name is Frank Weigand. I'm the General Counsel and Head of Listings at Oasis Pro Markets. Oasis is an SEC-registered broker-dealer licensed to transact in digital asset securities. So digital asset securities are tokenized equity, tokenized debt, tokenized real-world assets. If you think about the evolution of securities and start with bearer shares, then down to book entry, the next step in that evolution is using distributed ledger technology and the blockchain as a place to house or to evidence ownership of securities and transfer them easily between parties, beneficial to the issuer as well, and investors can get access to a broader range of investments, which we'll talk about later. And we're pleased to be working with Redwood on initiatives on their side to tokenize as well, as Cara mentioned. I got into blockchain because I wanted to do something different in the digital space. I have a traditional finance background, I think as a lot of us do. I was general counsel of HSBC Securities and looking around at different opportunities when I heard that there was an SEC-registered broker-dealer that could deal in digital asset securities. And lo and behold, I'm working for them now. It's a fascinating new area. Some people say, we're in the first inning, second inning. I think it's true. If you were to go to, a banking conference in 2010 and someone was telling you about internet banking and you can take photos of checks and that will be a way to deposit them, you might think, wow, that sounds pretty cool. I wonder if that's actually ever going to be implemented. And, you're doing it today. So I think we're on to the start of something really big here.
Excellent, Nelson.
All right, very cool. Look at that, standing room only. Really glad to be here. My name is Nelson.
We're betting on that.
We're betting on that, yeah. My name is Nelson Chu, founder and CEO of Percent. We have created infrastructure solution providing debt capital markets as a service, specifically for private credit. And so what we do is we provide software for issuers, for structuring agents, and for investors to be able to source transactions, structure transactions, syndicate them, surveillance them, service them. It's our 5 S's. And we've done about $850 million in the course of the company's life over the last 3 years and change, give or take, across 330 transactions. It's been a good run. It's good that I'm at the end of this introduction. I am going to be the resident skeptic and cynic on this panel because we have tried so hard to get blockchain to work, and it has failed every single time. So with that, I'll take it.
Who invited you?
Have you met Ian from Liquid Mortgage? I think you two should talk.
Well, in terms of an agenda today, we're going to spend a little bit of time just delving into the sort of the basics of the blockchain. I know we probably have a fairly diverse audience in terms of technical background, so some of our experts will give us a little bit of background on the blockchain, and then we'll walk through the life cycle of an asset just to talk about different enhancements we see kind of from the origination of an asset through the securitization and sale of a security and how that can be optimized using the blockchain. And then we have a bunch of questions for the panel, and then they were adamant they want at least 20 minutes to answer your questions. So most panels I've been on, we've always eliminated questions because we're worried, but this panel is ready and willing to talk about your questions. So why don't we, John and Ian, maybe you could talk a little bit about sort of just blockchain, blocking and tackling.
At a high level, blockchain is really just the evolution of accounting. You all know single entry bookkeeping. If you ever maintained a checkbook, and how for thousands of years with stone tablets, you just add and subtract from a single account, and at the end of that, whatever you get is your balance. And if you want to lie in a single entry book, all you do is change one entry, and you've changed everything. In the 1500s, we established what is basically the status quo, which is double entry bookkeeping. It's what we're all familiar with, where you have debits from one account that credit into another account. And at the end of the day, all the debits and all the debit accounts all have to balance out. And if you want to lie in this system, both parties have to lie, both accounts have to be changed. And that brings us into triple entry bookkeeping, which is that same system with a third party that comes in and looks at everything, issues certificates, and says, yes, I agree, this is true, this is correct. And that third auditor is what validates the double entry system. This works terrific unless your auditor is Arthur Anderson. The big challenge with triple entry books based on central middlemen is that you delegate all the trust to one person, one entity, and their stamp of approval becomes your symbol for trust in whatever the underlying transaction is. And that means that you give that middleman the power to create rules and systems around any kind of transaction data that can start to not work particularly well for the users of the system, and they can charge effectively any fee they want since they're their only real true source of trust in the system. Modern blockchains are just a different way of looking at triple entry bookkeeping. It's the same account credits and debits, but without a central middleman. And the attestations and the certifications are all based on cryptography, which is just math. The way it works is we develop a protocol. Everyone comes together transparently, builds the protocol together, and everyone agrees on just a set of terms and conditions that they want to run a network on. And in that network, everyone logs in, starts up their computers, and starts processing transactions, building work into that network. So it's an entire group of individuals computing and making sure that everything is correct, all the credits and debits match up, and everyone collectively validates and certifies everything so that you don't have any central point of failure, you don't have any central person you're looking to, but you're only looking at that protocol, that agreement of systems that everyone mutually brings together. With blockchain, you trust math instead of middlemen. That means you can go from the speed of people processing things in days, weeks, or months, to the speed of computers, just like that.
Yeah, I mean, the only thing I would add to that is, from a technology perspective, I think my advice to all of you is don't worry so much about the technical aspect of blockchain. You know, blockchain, at least the way we look at it, should be in the background running. It should be something that we can build applications on top of without you having to directly interact with a blockchain or learn how to, program on top of a blockchain or any of that. That's our job, right? We do that. And so our role is to really be able to bring counterparties into this ecosystem while we run the technology behind the scenes. If you want to know exactly what happens on a blockchain, we can tell you. But the only thing I would say is, from a high level, leave the technology, at least this piece of the technology, to the people that need to focus on that piece.
So John, the validating entities are the nodes, is that the idea?
Precisely.
Yeah. So the one thing to keep in mind too is, I mean, when you talk about Bitcoin, I think they have 30,000 nodes. There's blockchains that have 6 nodes, right? So there's all levels of kind of interaction, right?
No doubt. There are a lot of very, very small, very centralized solutions, and that's why really you kind of want to avoid those, because if you only have a couple of validators, it just becomes a centralized database, and you have all the problems of that central middleman who you're trusting with everything.
Excellent. Well, now we're going to talk about the life cycle of a residential mortgage loan, and the reason I picked that is because that's my specialty, and I'm the moderator. So, we're going to talk about sort of the origination through the securitization and how we think, how the blockchain can make things more efficient. And when I started my professional career, I told you I worked at Prudential Home Mortgage, and we realized very early on that our systems were not where they should be. We asked the applicants over the phone for their information, their address, their name, their social security number 20 different times in the same phone conversation, because we didn't have systems that would take information and move it. And when we talk about things here today, you'll see how far we've come from sort of minimal automation to where where we can be in the future. So Cara, since you're the closest, you work for a loan aggregator and purchaser, maybe you could talk a little bit about sort of the origination process for a loan. And we think that if you look at a loan, it could be for it could hold true for many other asset classes. But we're going to start with that. Maybe you could talk a little bit about origination.
Sure. The great position that Redwood is in as an aggregator working with about 180 loan sellers actively is that we get to see not only the loan at the point of acquisition, but then working with the loan through its life cycle as it's purchased, financed, hedged, file shipped to a custodian, included in a securitization. Our portfolio invests in loans. So we get to see loans really at all phases of the life cycle and work with counterparties that have many different touch points with loans. That gives us a lot of insight into just the inefficiencies and redundancies that are embedded in the mortgage finance ecosystem. And I like that John actually referenced stone tablets. I don't know that might be an exaggeration to say that the origination process is quite that arcane, but just to give a little bit of color for anybody that has not gotten a mortgage, when the loan is originated, the loan files are manually scanned into a system. A due diligence firm and perhaps an aggregator like Redwood will pull out the data, will evaluate key attributes of the loans, make recalculations to verify that the calculations that the originator calculated were correct. We then evaluate all of the data. In the meantime, loan files are boxed up, sent in an overnight package to a custodian who opens up a package of documents, manually checks in each of those documents, certifies to the purchaser that those documents have been received, and then takes the physical papers and puts the papers on a file or on a shelf in a warehouse where they're stored indefinitely. That process is obviously rife with redundancies and manual processes. And at the end of the day, the impact to originators, to aggregators, to all participants in the loan's life cycle is cost and time. The longer that an originator has to wait before a loan can be sold, it means the longer that they have to be financing that loan. It means the longer before an aggregator or a secondary participant like Redwood can purchase the loan. If there was a way to just upload that data and the documents automatically at the point of origination, there's the opportunity to reduce error and to expedite the time that it takes, or to shorten the time that it takes from the loan to go from origination to sale, which ultimately results in saved costs and saved time.
Excellent. Ian, you want to talk about what Liquid Mortgage can do to
Yeah, absolutely.
the process?
Yeah, absolutely. So I'll just talk about what we're doing today. So to Cara's point, all these different pieces of the ecosystem really need to be able to work together better. And so part of what we're doing is we can onboard a loan at any point in its life cycle, so whether that's at securitization specifically or at origination or any time in between or after that even. But essentially what we're doing is we're creating this digital asset backed by the one single loan. And once we've created that asset, we have this product that we call an archive. And we take this archive and it has data and documentation, metadata to every document. It's essentially this master archive of everything that happens for that for that loan over the life of the loan. So let's start with origination. So the originator has all of this documentation that Cara was just discussing. We can take that information, put that in the archive, attach it to the associated data, and then we wrap that all up and attach it to the digital asset. So at any point in the life of that asset, we can actually go back and verify that all of these things existed at this point, and we can see obviously the change history over time. So maybe a second step would be diligence. So we can also take all diligence data and documentation, put that into the archive as well, all the same archive, reattach it to the asset, and then we can see, again, in the future, every single time that loan gets sold, we can go back and see the diligence was done. We can see all the filings for that diligence. We can really see everything. And then think of the same for, if the investor has specific files they want in that archive, they can do that. If the servicer has specific files, they can also do that, and so on and so forth. And so that's kind of the first piece of what we're doing. And the second piece is on the payment side. So right now we're just tracking payments. We receive a daily servicer file for multiple servicers, and we record that data directly to the digital asset. So let's say there's a $1,000 payment that was made on a specific loan. We post that payment directly to the asset, and that way we have a history. Obviously, we're receiving a daily file. We'd like it to be sooner, but we have once a day we get this data tape, and we can actually put that on chain, and then any errors in payments that are recorded over time, we can actually see those. So if there's an NSF charge return payment. We can see that. It's recorded on the blockchain. That's what we're doing right now, is tracking. I can go into later what our plans are for the future with respect to us actually doing payments ourselves. But really the end goal of this is to make the entire securitization process better, more transparent, and to Cara's point, shrink timelines and reduce costs for everybody.
Nelson?
Yeah, I think, what's been interesting about this and reflecting on some of these comments, like a big part of the blockchain really is touting decentralization. But the problem with that is that you actually need to originate these assets on chain. Otherwise, the moment you don't do that, there's a lot of chance and issues that come up if someone mucks around with it before it ever gets to the chain. So that's a challenge that I don't think most people have solved for at this point. And on top of that, I think there is a big jump between, what Cara had mentioned around, yes, those things definitely should not be on paper, like they should probably be PDF'd at some point, but the PDF process is already leaps and bounds better than what it would be today. The question of whether a blockchain is necessary is really a big question mark, right? You can actually centralize a lot of this, and some would argue that centralization is a feature, not a bug. In decentralized environments, they like to tout that the irreversibility of a transaction is a feature, not a bug. I think that's actually a bug, because you need to be able to reverse something in the event something goes south. And so just because it's recorded doesn't mean that, like, for example, if someone sent money to the wrong address, you can't get that money back unless that person decides to actually be nice and send it back to you. So if that's the case, that's actually a really big problem, especially in the markets that we transact in today. So with all that being said, we've tried to attempt to take a more pragmatic approach, recognizing that the average user doesn't really want to or doesn't have the technical capability to maintain, their own wallet, for example, to hold their currencies or whatever it may be. And so when we first started this company, because we took investment from Coinbase, they thought we were a blockchain company, we started off by minting Ethereum contracts for every single one of the transactions we had done. That was essentially a mini securitization, right? So we were doing these, loans out there, and there were hundreds of investors investing in these deals. We thought it'd be a great value add to mint Ethereum contracts for each of these to help investors see how many investors were in the deal, trace the flow of cash. No one needs to interact with a wallet. We'll do it all for you. It's all well and good. And then Ethereum reached a point where it actually cost us $1,000 to do a transaction, and then we were only making $500. So I was like, this probably is not a good trade. We stopped that. And then that got shuttered. And so we thought, well, there's got to be some good things in this. So we're going to, at the very least, do the same thing for a larger transaction. And so I'm proud to say that, and Forbes had a really nice piece on us on this, we were the first ever securitization with a ratings agency report that covered a digital asset element to it. So we actually were in DBR's Morningstar's ratings agency report for this $40 million whole business securitization we had done for a franchise business. Having said that, we wanted to transact in a USDC so you could, originate the flow of funds on chain. And this multi-strat, multi-billion-dollar credit fund said, if you force me to transact in USDC, I'm pulling out of this deal. So we walked that away, and we said, we're not doing that. Sorry. Don't worry about it. Just close the deal, please. And then after that, we said, we're still going to keep trying here. We're going to try more stuff. And Bloomberg did a piece on this for us maybe about a week and a half ago. So we actually partnered with a company that we helped create called Onzen. And they're essentially doing credit default swaps for private credit markets, right, which is like super interesting. And so we knew that was a gap in our business, being able to offer credit protection. And we recognized that, maybe there's some elements of DeFi and blockchain we could bring in here. And so we did actually launch that first transaction. What they're doing is essentially using decentralized finance to generate yield on one side, and then real world yield coming from percent to kind of build up this treasury reserve. The problem is that DeFi yields right now are lower than US Treasuries. And so there's not a lot coming from that yield on that side. It's actually all coming from percent, unfortunately. But in the event that, decentralized finance yields come back, then maybe Onzen will have something more to share. But that's our trials and tribulations with the blockchain over the last 3 years that we've tried very hard to make it work, and it's just been a struggle ever since. But we like our chances in the future. We hope it'll turn to something, but we're trying as best we can, I think is the best way to put it.
Thank you, Frank.
Sure, and it is a bit of a journey and to try to get critical mass in the market, but we are seeing that from an issuer perspective. Issuers working with us on different securities and securitizations to tokenize the offering and offer it through us on our initial issuance platform. It can then be made available for secondary market trading on our ATS. ATS is an alternative trading system. Think of it like a private exchange where we onboard the issuers, as I mentioned, and then we onboard subscribers fully KYC, AML through broker-dealer compliance procedures. And by doing that, we eliminate a lot of the friction of the ordinary capital markets. We also make it easier for the issuers to have awareness as to who's on their cap table, who the investors are, also secondary market liquidity and things that are presently difficult to transfer. And Nelson, you mentioned the difficulty with digital wallets, but we're actually seeing a fairly significant uptake on that in larger market players, bulge bracket investment banks, creating wallets for their clients. So alongside your brokerage account at XYZ investment bank, you can now have, or in the works is being developed, a digital wallet to hold crypto or digital asset securities, which is what I'm describing here. KYC, AML, the clients, and then from a transfer perspective, if you think about things that are hard to transfer today, like LP interests, if you have a number of different LPs who are whitelisted, meaning that their wallet address is KYC AML'd, they can instantaneously transfer interests between one another if the issuer is open to that. And we're finding that folks are really interested in offering their clients that type of liquidity and instantaneously transfer. They'll have a bid and ask up on our ATS, and if those match, that then proceeds into a transfer of the security between the parties. So moving in this direction in a regulated space, right? So this is fully SEC regulated. We also have full-scale investment banking licenses that a traditional broker-dealer would have, but layered on top of that, the digital asset securities capability. And people right now hear the term digital assets and they get nervous that this somehow relates to crypto, and crypto is very problematic. It has nothing to do with crypto. It utilizes some of the same technology, which can actually be very efficient and very useful, but it is traditional banking at its core.
Thank you. John?
So a little bit further down the MBS process, once ideally everything gets securitized and it's being offered in a sale to public investors, in a perfect world, the repayment process and the shareholder, the investor perspective is where you start to have just a little bit of a challenge with the way everything gets processed. Nowadays, if a debt issuer makes a repayment, if the homeowners pay their mortgages, that payment goes to a corporate trust. The corporate trust sends the money to DTC as a commingled transfer agent of the securities. DTC sends the money to a settling bank. The settling bank sends the money to a bunch of clearing participant accounts, and then all the clearing participant accounts send the money and the final dividend or whatever the payment is to even more investor accounts. So that's 5-6 people in a pretty simple repayment. So ideally, we could use some pretty simple distributed ledger solutions so the money can just go from the issuer to the transfer agent to the investors.
Excellent. So we've talked a little bit about sort of mortgage loans. We've talked about limited partnership interest transfers. What other assets do you think are, could use some new technology in terms of origination through securitization?
Yeah, so I can speak to that. We're seeing interest across the board in fixed income, really. Anything from credit card, obviously commercial and residential mortgages for sure, credit card issuance, and also other markets. For example, Mexican consumer loans, which might sound random, but if you think about how much it would help from a data perspective to attract institutional investors in the U.S., it actually becomes very important. Similar to securitizations in Europe, or actually just loans in Europe right now. We're seeing the same thing, interest there because typically the data is horrible. I used to look at these pools, and Italian RMBS is not an ideal securitization, but it has no data. And so our goal is to bring the technology to really all sectors within fixed income, starting at the loan level, obviously.
Any other thoughts?
Another component that technology can offer is fractionalization of securities, whereas previously things that wouldn't necessarily lend themselves to either fractionalization or the current process doesn't allow you to do that, but you can do that with the technology that we're talking about.
Yeah, and especially with just jumping again, with things, with large loans in particular, so aircraft lending, for example, obviously those are pretty large check sizes, and so we used to trade these things all the time, and to be able to fractionalize an aircraft loan, it could be pretty valuable, especially if you're starting to securitize fractions of aircraft, essentially, or of aircraft loans. So same with commercial.
What about commercial loans? Have people looked into sort of the debt stack in a commercial loan and figuring out how to?
Yes, we're looking at it right now, yeah.
Looking at? Okay. Any regulatory developments that anyone on the panel wants to speak to in this space?
I mean, I'm happy to jump in on that, and the fact that you have firms like Oasis Pro Markets and a couple of other companies that the SEC has authorized to transact in digital asset securities is really the only regulatory development we need to hear about in this space. They view it as a viable wrapper type for a security. They've supported the industry in putting out guidance on settlements, guidance on custody, other areas. There's criticism that they could move more quickly or could provide even more guidance, but they're on board with us, and both the SEC and FINRA have special teams that folks can speak to about these asset classes and the like. I think some of the other regulatory developments, Stephen, that we're seeing relate a lot to crypto. So when you hear about the Lummis-Gillibrand bill and other things coming out of the Hill, those are all crypto-related, trying to get clarity around whether it's SEC or CFTC that will be responsible for regulation. How are we going to classify all of the different tokens that are on Coinbase, regulation of stablecoin, et cetera, et cetera. That's what the Lummis-Gillibrand bill is about. But again, that's not what we're talking about here in this context. It's securities, just with a different type of technology wrapper.
Anybody else have anything to add on regulatory developments?
Moving back into the mortgage industry, and in particular in mortgage finance, we're reliant on the laws of 50 states, which for things like recording can just have very idiosyncratic, specific state-level rules. So unifying, coming up with a codified, uniform set of rules that can help a company like Liquid Mortgage or an aggregator like Redwood acquire loans in all 50 states, as we do in Redwood, and integrate technology that works in all 50 states would be incredibly helpful. And then I would just add also, in terms of data security and other hot topics, it's going to be interesting to see how Lummis-Gillibrand and some of the other regulations implement the desire for prudent regulation and allow for creativity, because particularly with things like fractionalization and tokenization, there is a lot of room for development and a lot of room to grow in the market.
I think this is not necessarily regulatory related, but it is legal related. The concept of a workout doesn't really exist on the blockchain. It kind of is just, when it's done, it's done. There's a smart contract that essentially requires if this, then that, effectively. And so I think we all know workouts are a pretty common part of the world that we live in. It's out of necessity, and so things can't happen immediately. And it's just something that I think it's going to have to get figured out. It's something that it poses a lot of challenges, I think, for blockchain adoption as a whole. If it's going to be automatic, if this happens, then that's going to happen, the cash has to go out, there's no room for error, there's no room for mistakes in that instance. And the ability to walk things back is critical in this instance. Otherwise, if you open the room to walk things back, then you're essentially relying upon a third party or a centralized entity to be able to kind of make that change, and it kind of defeats the purpose of a blockchain to begin with. So it is just something that I think there's nuances to this that the industry hasn't figured out yet, and there are definitely challenges in working on things like this.
And I agree with that, actually. What I would say is right now the workout situation would most likely happen outside of the blockchain world. What I will say, though, is the technology and the structuring of these assets, the data, documentation, everything associated with those assets can actually help in the process of going through any kind of loss mitigation or any workout scenario. Having validated data and essentially an entire time-stamped history of that asset, when payments were made, when certain things happened, is extremely valuable in those workout situations. So they may happen outside of the blockchain world, but the things we can do with the technology with respect to validation and verification is extremely helpful in that situation.
Thank you. Well, we could sit here and talk amongst ourselves, but this panel really wants to hear your questions, and they want to be stumped, so I don't know what the prize is if you stump someone. But does anybody have any questions at this point? We'll just pause and see. All right.
The size of the archive documents that you guys are storing, aren't you guys storing that in a centralized repository anyway?
We are not, no. So I won't go into the technology, but it's actually a very thin file, and so the contributor of those documents still retains the documentation on their infrastructure, and so the way it comes into ours is via specific links. We do certain things with those links to verify the document, provide the metadata. So our files are actually relatively thin, where the contributor is still responsible for holding those assets on their own. And that also helps in authorization to view documentation, right? So.
Yeah, just going back to John's point about, this being a way of kind of cutting out the middleman. I'm curious, can you be a little more specific about, because I'm hearing a lot of different, ways in which this is being utilized. Who exactly are you cutting out on people?
So you've got some very CLO MBS guys up here that probably have different answers than I do. We're more in traditional financial markets, so that's going to be people like the DTCC and the big central accounting intermediaries that are going to be doing most of the consolidating and reporting to the DTCC, and everything up from there up till clearinghouses and national securities exchanges, brokers, the likes.
Your point's a good one, though, right? Which is, at its core, you can automate things without using a blockchain. I think that really is the question. Like, these players can still exist and automate a lot of these transactions and these parts of the process, and the rationale for the blockchain becomes the question at the end of the day. Like, why does it need to be on a blockchain versus just building an if this then that statement without being on chain? Is really a thing that we all need to figure out.
So every intermediary I just mentioned, I mean, they're all extremely bright, very well funded, very smart collections of individuals. The challenge that I've seen them run into when they try to automate a lot of these processes, especially there was a recent study where a lot of the very big corporate trusts tried to automate the proxy statement process. And a very, very large challenge they run into is the regulation is very clear on how systems need to be in place when you have custody or control or ownership holds on investors' assets. And they're very strict, as they should be, around security and equal access to markets to make sure that Alice doesn't have a better chance of buying at a lower price than Bob. And these very strict systems that need to be in place to make sure everything is fair require a lot of auditing and just dozens of employees who do nothing all day but analyze logs and make sure everything is working properly and generate reports to send to regulators. And that's a very expensive proposition that just comes with any central middleman that's using their own proprietary automated systems.
I mean, are we talking about cutting out people necessarily, or just having them do different things potentially? Is that more what we're talking about?
Well, I'd actually approach the question just from a slightly different angle. And one of the fundamental premises of blockchain technology is that there is a trusted permanent record of the data that all parties recognize as being authentic. So, for example, in the secondary whole loan trading market, Redwood, as an aggregator, might diligence all loans that we purchase. When they're offered for sale to whole loan investors, that whole loan investor might rediligence loans that Redwood has already, and in many cases, just recently completed due diligence on before the purchaser completes their due diligence. If there was an ability to, at the point of origination, upload due diligence that all parties trust as authentic and validated and tie that to the mortgage loan through blockchain technology, that could expedite Redwood's potentially initial purchase of a mortgage loan and then prevent or remove the need for the secondary investor in that loan to re-perform the same diligence that Redwood had already just completed. So that's not necessarily taking a party out, it's removing redundancy that is inherent in the system.
That is on the condition the data that was uploaded is accurate the first go around. So it is considering that somebody who looked at it actually is, it was uploaded correctly, there was no mistakes, and that's actually correct. Because it goes to what Ian was saying about the off-chain part. The moment something goes off-chain, like, you got to actually bank on it being correct at that point.
But the thing is, so what you can do though is, and this is what we do, is you can actually, in this archive concept, every single time that's updated, so if somebody figures out something was wrong, and they re-upload a new document, and you can see the other one was replaced, and we're tracking all of that, you can see exactly the timestamp, at least the way we've built it. You can see the timestamp, you can see the person that did it, you can see exactly what they changed, and then you can go back and roll back to previous history as well. And so, that's really the value add, I think, to Cara's point, to be able to see this data and be able to validate the information, or at least validate the transaction history.
In that instance, though, would the secondary investor still have to decide which version is correct, no?
Yes.
Okay.
So they could either put it through diligence again, or at least they can see the entire history of why was the FICO score changed from this to this.
And the point is that you're not removing the fact that there was an error. You're preserving transparency into the fact that there was an error, and this was the agreed upon resolution of that error for any subsequent purchaser. So you're not wiping away the fact that there was a mistake. In fact, you could say that leaving evidence of the mistake is actually helpful to correct and avoid future mistakes.
More of a basic question, like what's the total volume of loans that are settled using the blockchain technology? I mean, you can pick the asset RMBS, CMBS, CLOs, pick your asset class.
Well, I can take that one. So right now, working with Liquid Mortgage, there's 5 Sequoia securitizations where Liquid Mortgage has created parallel digital assets for each loan in each of the 5 Sequoia securitizations. Corvest, another Redwood company, just closed its first securitization with every loan in that business purpose securitization having a parallel asset. So Ian, I think it's up to...
Right now, we have 2.7 billion of assets, but to the broader market, I honestly have no idea. That's our volume. Obviously, there have been some pilots with other firms, and especially between banks. I'm just not privy to that information.
Private securitizations, are they public? Can I pull up a QSIP from Bloomberg at least?
I don't believe. Oh, for the Redwood transactions? Yeah. I mean.
Yeah, any user wishing to access daily payment files, which is what we work with Liquid Mortgage to make available to any interested party, can just log on to Liquid Mortgage's website. You don't need to be an investor in the securitization, and that gives you access to daily payment files from, in most cases, the prior day. So a borrower makes a payment. Redwood servicer transmits a daily payment file to Liquid Mortgage, which is then uploaded by Liquid Mortgage. Sorry, I'm taking words out of your mouth to describe your business. Uploads that daily payment file to Liquid Mortgage's website, and then it is available within about 30 minutes of the time that you receive that file to any interested party that wishes to access that information.
And that data is the information, to be fair to all investors, is all located in I believe in the OM, right?
Correct. Yeah, we provide the link to that website in the offering document, and any interested party, doesn't need to be an investor, can view that information.
I have a quick question with your distributed ledgering. So I heard there's nodes, the word node on there. So what are you guys using for your proof of work in terms of validating the data? From what I understand, I just heard that if there was a scenario where there was 2 types of transactions that needed to be validated, it would have to be manually looked at. But the idea of distributed ledgering is to have multi-nodes that are self-policing, so that way that doesn't have to happen. It's supposed to be able to be on a blockchain where multiple nodes are knowing the reputation and character of each other's blockchain. And so that was a question I had. Have you considered the fact that every station is a node? And if there's less than 3 nodes, you don't have a cluster, which means you cannot validate the data. So validated data is important in this scenario.
Can I take that? All right. So the one thing I just want to make this clear on, so we're using a public blockchain, right? So we're using public blockchain. IBM supports it, MoneyGram supports it, Deloitte, Franklin Templeton, a lot of massive companies around the globe. And so the concept of a node is not validating the data necessarily that goes onto the blockchain. It's validating the structure of every transaction. And so essentially what the structure looks like, right, there are servers all over the planet. And what these servers do is they replicate all the transaction history. And so if you're running a node, right, you run these servers, and there's some technology that sits on top of it to validate transactions, not verify information is correct. And so what the technology is doing is it's saying, does the sender exist? Does the receiver exist? Does the asset exist? You know, essentially all these points of a transaction, it's saying, do they all make sense? And if they do, I'll let the transaction go through. And so we send a transaction, we run 3 nodes ourselves. IBM might be validating it, right? But it's not validating the information we're putting on, it's just saying, this is a valid transaction on this blockchain, period.
So it's validating the actual 2 transactions, but not validating if there's a spook within it.
It's not validating the data. So like, let's just say, use an example. So you know, I send you a dollar stablecoin, right? So just one. And so what it's going to do is it's going to look at the transaction and say, well, I exist and you exist. And I happen to have one stablecoin in my account, one US dollar stablecoin. So I can actually send it to you because I have the permission, I have the asset, I have the right amount, the quantity. And it's just saying, yes, the transaction can go through on the blockchain, but it doesn't say, oh, I meant to send you half, right? It's not going to validate that because that's my fault. If I'm putting data incorrectly on the blockchain, that's my fault, but the transaction will still be approved by the nodes as long as it fits the right structure.
So we both use the Stellar network, and one of the really big things a node will check is the digital signature. So locally, you're going to digitally sign all the information that you want to attest to and have take into effect. And then just using standard modern cryptography, every peer will validate and say, yes, this is a valid signature. And that's how you express that you want to do exactly this and only this and make it so.
We have time maybe for one more question.
Great conversation today. Thank you, everyone. Quick forward, if we can, into emerging asset class. We've seen a couple of new issuers come to it and say, hey, intellectual property was blockchain or with carbon offsets. For offsets, is that a potential silver bullet to help some of the controversies and black eyes around issuance and then obviously retirement of the credits?
Adam Newman would like to think so. Is that a good thing or a bad thing for the industry for carbon offsets? I think that's yet to be seen, given what he's done with WeWork. But yeah, look, I think it's something that is really interesting. There's a lot of use cases for this, regardless. And you know, we've touched on them here. It's really a question of whether it's adding that much more value than what's there today. I think you've heard a spirited discussion on this panel as to the pros and cons of it and how close we are on some things and how really far away we are on other things. I think carbon offsets is another one of those that's like, I think it desperately needs it. It's one of the most messed up industries out there, honestly, today. But can the blockchain help enough, or is there just too much wrong with it? I think the jury's still out on that one.
Excellent. Well, thanks everyone for coming, and the panel will probably be here afterwards if you want to ask any more questions.